By the end of this video, you will not only know what market cycle analysis is, but you will also understand how you can use this strategically to improve the profits and returns on your trading and investing. What is market cycle analysis? When traders first encounter the markets, one of the biggest challenges is the randomness they appear to show. Prices move up and down, and sometimes in sharp swings, and it can feel like there's no structure behind it all. Market cycle analysis is a way of finding order in that apparent chaos. A cycle is simply a repeating rhythm, a pattern that tends to unfold again and again over time. These patterns can be influenced by human psychology, economic forces, or natural timing elements that appear in markets itself. By studying cycles, traders can move beyond guesswork and instead recognize the phases that markets tend to pass through. The goal isn't to predict the future, but rather to understand the probabilities, the tendencies, and the timing of when the market may shift from one phase to the next. Let's discuss trader psychology and the cycle of experience. It's useful to think about the cycle every trader personally goes through. We can break it up into 3 stages. Stage 1, it's the beginner who tends to trade impulsively. They might jump from one strategy to another, constantly looking for the magic system that always works. They usually focus on quick wins and often ignore risk management. Stage 2, this trader begins to journal, track results, and reflect on what's going on and what isn't. Instead of constantly switching systems, they test ideas and outcomes, and they make records. They start to see the market as a place to manage risk rather than chase certainty. And stage 3, the trader has matured emotionally. They've internalized patience, discipline, and consistency. They know losses are part of the process and focus on execution rather than prediction. Cycles analysis is useful at every stage, but it really becomes powerful once a trader accepts that markets move in rhythms, not straight lines. Identifying and projecting market cycles. So how do we actually identify cycles in the market? Markets leave behind clues in the form of peaks and troughs. By studying the time between the major highs and lows, traders can begin to estimate the length of cycles, whether short-term trading cycles or longer-term investment cycles. A good example is the S&P 500. By looking back historically, we see that it often experiences repeating rhythms. These may not line up perfectly, but the tendency is for markets to expand, peak, contract, and bottom in recognizable patterns. The S&P 500 is one of the instruments that we cover in the market timing report, and within that report we have consistently been able to highlight the turning points using cycles analysis. Projection doesn't mean certainty, however. Instead, it's like having a map. You know roughly where the twists and turns are likely to be, even if you can't predict the exact positions of the road. So what tools and techniques can we use? Several tools can refine cycles analysis, such as spectrum analysis, cycle skew, panic indicators, and price dampening. These tools are worthwhile to investigate, but we won't do that here, as we want to keep this video as concise as possible. What we will talk about, however, is how we look at cyclic activity from a daily, weekly, and monthly, as well as yearly and multiple year perspective, such that we can fine-tune the potential trend changes down to finite time periods, i.e. individual days. If a number of cycle patterns, say a weekly and a monthly cycle pattern, are occurring at the same time, the potential for a trend change is stronger than it is from a weekly cycle alone. If a yearly cycle pattern was also evident as well, then the trend change is even more highly probable. It's going to be a major turn in the markets. Market cycle analysis requires looking at the market from many different perspectives and not from just one single pattern. So how do you make the most of cycle trading? Cycles aren't limited to one market. They play out across asset classes and sectors. We use a tool called the Advanced Seasonality Platform to expand our range of trading beyond the 6 instruments covered in the market timing report. Now, this platform allows traders to view and analyze additional sectors, currencies, asset classes to further fine-tune their trading whilst using the market timing report as their overall 50,000-foot view of the coming month's potential trend changes for the main 6 markets. Combining the two gives additional perspective and timing, but needing both is not required. Let's talk about putting it all together. Market cycle analysis is about rhythm, probability, and timing. It's about recognizing that prices don't move randomly, but rather pass through the recurring phases shaped by psychology, liquidity, and external forces. The market timing report lets you see how that cycle analysis plays out across the S&P 500, gold, Bitcoin, the US dollar index, crude oil, and the euro. By adding in seasonality data, traders can deepen their understanding of where they are in the broader rhythm, as well as trade many more markets. When you understand cycles, you stop reacting emotionally to every move, and you now have the odds on your side.